Have you ever been in a situation where you make your analysis, you do your research, you set your positions, you open your trade, and then everything goes south? With everything looking perfect, it just seems like the market was waiting for you to open your position, get into the market, and for it to just take away your profit. That thing you are feeling right there is what we call liquidity inducement. Liquidity inducement can make you question if you know what you're doing at all, doubt yourself as a trader, lose your belief, or even make you start wondering or start giving the thought of you quitting trade. In this video, I am going to help you understand what liquidity inducement means in trade, how to trade with it, identify it, make it work for you and not against you as a trader, and what you should know before setting your next trade. However, before I begin, I want you to know the following. Number one is the fact that liquidity inducement is a planned price action carried out by the big boys in the trading system to sweep out liquidity, or let's say, what is it called in the layman's language? Profits or even capital from retail trader in the trading system. Number two, the ability to identify liquidity zones would help you anticipate liquidity inducement while trading. It will help you know when there is about to be a liquidity inducement in the market, so you will not enter trade at that particular time. Number three, understanding the trading and market structure would help you reduce the risk of falling from liquidity inducement. Number four, which is the most important in this particular notes I'm giving you out, or let's say key points I'm giving you out, is the fact that mastering, developing the skill of patience and confirmation before entering your trade will help you reduce your loss and increase your profit as a trader on a very, very, very large scale. Now, I'm not just going to teach you how to identify liquidity inducements. I won't teach you how to know all of these things, but I will help you develop the 4 key points I have mentioned earlier and how you can get to now trade as a pro when you understand the concept of liquidity in trading. Liquidity inducement is one of the most common concepts that is yet overlooked and purely misunderstood that institutional traders always use to rake in profit. Understanding liquidity inducement is the very thin line between you having profitable trades and keeping your loss. You might be wondering, what exactly is liquidity inducement? Come closer. Yeah, come. Let's discuss it. Very well. Liquidity inducement is the strategy of deliberately engineering price action to entice retail traders to take trades at unprofitable prices. This is an act of influencing open orders to portray false breakouts, false resistance, false supports, anything that looks like a mirage in the trading space. Just think of this thing as a bait. I'm going to show you a practical, example of liquidity inducement in action that has happened over and over time again. And the funny part of liquidity inducement is it works every time. And that thing actually just, it makes me feel one kind. It is always working. And I don't know why people always fall for it. That is why I said it is one of the very common, yet overlooked, misunderstood, or let me say underrated. Like people just get to underrate it most time, but it's why you're losing your money. They make you take trades, they flip the market, and they sweep in liquidity from your own losses. In basic terms, let's look at this like a game hunt. The liquidity is the price. Inducement is the strategy. Before you understand the concept of liquidity inducement, you have to understand what liquidity itself means. So there could be different and numerous definitions of types of liquidity when it comes to trading. However, I like to deal with just 6 of them. Number 1 is market liquidity. Number 2 is funding liquidity. Number 3 is the buy side liquidity. Number 4 is the sell side liquidity. Number 5 is the range bound liquidity, and number 6 is the asset liquidity. Market liquidity refers to how easily an asset could be bought or sold in a market. A liquid market has both buyers and sellers, and these people trade interchangeably in a way that it is done and executed quickly without significantly creating a price change in the market. On the flip side, funding liquidity is the availability of funds to meet liquidity obligations or to be able to finance your trade. I believe this doesn't really have to be explained that much, because if you don't have liquidity, if you don't have money, you can't trade. So that is what we call funding liquidity, the ability to be able to fund your account with money to enter, execute, or create, or let's say answer to financial obligations. Asset liquidity refers to how quickly an asset can be converted into cash without losing its value. or quickly losing its value. For an example, you have your USDT, you want to convert it to your Naira, to your Ghana series or whatever, and you are looking for where to sell. Just come to me, sell it to me, I'll buy it for you. I'll buy it for you, or buy from you rather. Or if you have your Ghana series or your Nigerian Naira or whatever, your US dollar, and you want to convert it to USDT, come to me, I will buy for you and send it to your wallet. The process of you doing that is what we call asset liquidity, converting different assets without them quickly losing their value. Now, let's talk about the 3 types of liquidity we are going to be focusing on in this particular video, which is the buy-side liquidity, the sell-side liquidity, and the range-bound liquidity. The buy-side liquidity refers to a cluster of buy orders above a certain or a peculiar resistance level in the market, just like I've showed you in the example of liquidity inducement. It is, the cluster of buy orders when there is so much buy order above a particular resistance level. And whenever institutional traders want to execute a very large sell order, they oftentimes push up the price of that particular commodity just slightly above or a little above the resistance level. So when people get into the euphoria, they tap into the euphoria, they sell off and tap into liquidity at the bottom. The same thing also applies to sell-side liquidity. It is a cluster of sell orders slightly below a support level. And whenever they also want to execute a large buy order, they influence price action to go below or to go to this particular zone, so they could buy at a very cheaper rate. Range-bound liquidity. This is cluster of orders, that exist just at the top and at the bottom of a particular, price range for a commodity. Let's say, for an example, from 5,500 to 5,000 or 4,500. So there's cluster of order at 5,500. There's cluster of order at 4,500. This is what the institutional traders always do whenever there is an indecisiveness in the market. Now, this is where the story starts to get very interesting. What are the signs of inducement that you must watch out for when trading? Number 1 is unusual volume spike. Whenever there is an unusual volume going on in the market, you just get to you're trading and you are looking at your volume. Let's say you're trading on your Binance or your Bybit. There is the volume bar just below, you will see it. And there's just an unusual spike, just piam, the thing just goes up. And the thing is actually not reflecting in the price action. You should know that there is something going on. Definitely that is telling you that there is an involvement of institutional traders trying to manipulate the market in that particular trade. Number 2, quick rejection candles. While trading, you have to watch out for long rejection candles. Short candle with candles with long wick, short when the market just goes red, but it is showing a very long wick. That is, the body is not filled, and this particular reversal spike is going to cut through some levels before going up back. Maybe you're just seeing a candle and the wick is just so long, but cuts through a particular support, then goes up back. That is a liquidity inducement that has just happened, and you should be careful, because whenever liquidity inducement happens, the market is still definitely going to come back to that level to test it. Maybe that is a support zone, or there is going to be a need for a new support. Number 3, break of structure without follow through. So whenever you're trading, let's say maybe you are trading and you're following a particular market trend, maybe you notice that this market trend is a channel and you're trading through the channel, you're taking your profits, you're setting your top loss, your stop loss, and you just get to see that the market breaks through that particular trend, but there's no follow-up. It breaks to that trend, but there's no follow-up action, to push it or to continue. That is a liquidity inducement. You should know the market is already being manipulated. You're trading a channel, let's say a reversal channel or a descending channel or an ascending channel, and the market just cuts through that particular channel without following, and you see that it's coming back up. You should know that's a liquidity inducement. That is something that is telling you that manipulation is already setting in. The last one, which is very important, is divergence without indicators. Whenever you notice that the price is going high while trading, but your RSI is not confirming this price change. Maybe there's an high price or there's a very, very, very low change in price, but your indicators, your volume indicators, your oscillators are not telling or confirming this thing. You should know that is liquidity inducement right there. And if you want to understand how you can get to use your volume indicators, your oscillators very well, check out this video where I actually explained everything about oscillators and volume indicators and how you can get to use them to trade. Now, let's talk about why you must know liquidity inducement and why you must know how to identify liquidity inducement. And being able to to spot out liquidity inducement would help you avoid risk. The ability to identify liquidity inducement in a trade will help you avoid entering markets or making entries at manipulated prices. So whenever, instead of you, and this is what is going to save you, now that thing that happens to you, that whenever you set your trade, the market will just reverse. Whenever you set your trade, market will just reverse. It's because, for an example, you want to enter a buy order, and whenever you want to create your buy order, you're always looking for the cluster of buy orders. That is, you're looking, I will enter this thing, I will set my buy order whenever it cuts out from this particular resistance zone. So by that time, I know it has broken off, so I will enter the buy order. You see, that thing you want to do right there is you being induced, because above that resistance zone is not the confirmation that the market is going out. That is where they are going to take in your profits, because they are going to manipulate the market to go below, just like what is happening right now as I'm recording this video on the BTC USD chart. It protects your confidence as a trader. When you understand these tricks, it helps you boost your confidence and reduce self-doubt whenever the market or the trade goes wrong while trading. So maybe, for an example, you set a short position and you see that at your entry level, when you set a short position, the market is going into a buy order above the resistance level. You would not want to quit your trade, because you would know that, oh, this is a liquidity inducement in play. So it will also help you set your stop loss in the very right way, because you won't be setting your stop loss according to your own psychological intelligence, but from your financial and technical intelligence as a trader, understanding that you need to avoid liquidity zones whenever you're setting your stop loss. Least set it above the liquidity zones. Understanding liquidity inducements helps you trade with smart money. When you trade with institutional traders, when you go with the flow of institutional traders, it helps you increase the chance of you having profitable trades while trading, or even as a trader, because they most times don't lose. Lastly, it helps you preserve your capital, avoiding fade outs, avoiding fake entries, avoiding fake breakouts, fake resistance and support zones. We help you preserve your capital in a very long time and save you from the stomp hunt of funding, losing your money, going to hustle 9 to 5, put the money in trading, lose it again. It will save you from that cycle and help you increase your rate of having more profitable trades than losses. Now let's talk about how you can trade, or how you will be able to trade profitably with liquidity inducement. There are two approaches to how this thing works. And we are going to be looking at both of them. That is, the first one is we have the approach of the buy side liquidity and also the approach of the sell side liquidity. The buy side liquidity means when you are trying to apply it in a long position, or let's say in a buying position. And for the sell side liquidity means when you're trying to apply it in a sell side position. So the first thing you need to watch out for when you're trying to make a buy order and you want to trade with the liquidity inducement is you have to watch out for resistance levels where multiple rejections have occurred. Like I mentioned earlier, that the buy side liquidity happens when there is cluster of order above a resistance area in a particular market. So for the sell side liquidity, you also have to find support levels with multiple bounces. Whenever you find this kind of support levels with multiple bounces, you should know that is the most likely place where liquidity inducement might happen, and that is where you should set your entry. Now, for another one is for the buy side liquidity, you have to watch out for lows where protective stop loss accumulate. Now, whenever you notice that maybe you want to enter a particular trade and you notice that this is a very support level, a low level where which there has been, if you could actually access the order book of maybe your exchange or whatever broker you're trading with, and you notice that there are a lot of stop losses at this area, do not enter your trade at that particular point, because if you enter at that point, they are definitely going to flip the market to the other side. What I mean by that is, if you are entering a low position, your stop loss will be below your entry point, and if you notice there are a lot of stop loss at that point and you want to go up, they are going to flip the market on you. Also, watch out for the sell side liquidity. Target highs where many traders likely place sell order. Now, you want to enter your trade at this point, you have to target places where many traders will definitely place their own sell order. That is where you should set your own buy order. Do opposite of whatever is about to happen. You also have to watch out for psychological wall numbers like the 100, 500, 1,500 or something like that. So maybe you're trading, let's say for an example, you're trading the Solana USDT pair and you notice that, or you want to take your profit at 200. You should know that is a psychological number that has effect on the market. Or you're trying to beat an all-time high. Let's say for an Ethereum now, you set your take profit at 5,000. You should know that is most likely not going to happen at the time you expect it. It will happen where they are definitely going to sweep off the liquidity on the market. So also for your sell side, you have to watch out for round psychological numbers just below your current price. So you watch out for psychological numbers below your current price, that also round figure. And lastly, also for the buy side, you have to check out or observe clusters of pending buy orders on your order book. Whenever you have a lot of pending order, that particular price where you have a lot of pending orders, do not enter at that point, because they're definitely going to flip the market over at that point. That is where they want to tap the liquidity from. So if you also want to enter your own buy order at that point, you should know they will take out your liquidity from you. You also be part of the victim. You do not enter at that point. You might want to enter below that point. You understand? And for the sell side, you also have to monitor areas where previous sharp reversals have occurred. Don't enter your sell order at such points, because they will create a false breakout, make people think, oh, the market is definitely going to go up. And when they get that done, after they've done that, they will make the market go down again. So you do not enter that point, you enter slightly above. So you don't get to lose your liquidity to the institutional traders. Mastering the concept of liquidity inducement will help you change how you approach the market. It would also help you position yourself, avoid manipulations in the market, and also trade along with smart money and increase your profit rate, or let's say your win rate as a trader. And if there is anything I am very, very, very certain about, is the fact that after watching this video and when you start applying the lessons from this video, you will start seeing the market from a different lens, seeing the market from a different angle, one that would help you understand what is actually driving the flow of price action in the market. Use it to your advantage and not against yourself. Help you have more win rate and reduce your loss streaks. One more thing you need to do is the fact that if you are ready to scale up your trading journey as a trader by just a notch higher, just a little bit higher, that will be of significant results, you should subscribe to this channel, hit the notification bell, like this video, share it to your colleagues, let YouTube know you are getting premium content from this channel so it can get to recommend it to other people. You can't be selfish. This is a premium information coming to you on a very basic or a very common level. See, when next I come your way, stay cool and play big.